To be a good investor, I think you have to be a good observer and a good listener. Of course, there are always bumps in every company, but we think the U.S. economy is in reasonable shape. You obviously have to learn from your mistakes, but what matters as an investor is not what you did when you made the investment. What matters is today.
Private credit has exploded into a $1 trillion market, fueling deals, reshaping lending, and raising new questions about risk in the financial system. But Centerbridge Partners co-founder Jeff Aronson isn't worried.
The private credit market is very large. It's measured in the trillions of dollars. But do I think it poses a systemic risk? I don't.
Jeff Aronson started his career far from Wall Street. He studied political science, went to law school, and became an attorney. Then came the stock market crash of 1987. It wiped out his firm and forced a decision that would change his life.
I'm newly married. I have student loans up to my neck. I don't want to be a lawyer, and my firm just went bankrupt. So I went to John and Michael, and I literally said, give me a chance. I want to be an analyst. And I actually said, I'll work for free.
That moment launched a 16-year run at Angelo Gordon, and eventually a bigger leap.
I didn't care about my name being on the door. And we never argued over money or anything like that. I mean, they made me wealthy. I wanted a chance, the phrase I used, to drive the bus.
In 2005, Aronson co-founded Centerbridge Partners. Today, the firm manages $47 billion across private equity, private credit, and real estate. And while he's now at the center of one of the fastest growing areas in finance, Aronson says success comes down to timing, discipline, and a willingness to take risks.
I'm incredibly lucky. I'm not superstitious, but I'm a lucky person. I've been in the right place in the right time, and that's why this is a great country. Look what this country is able to afford someone if you're smart and you're hardworking and ambitious and have a little bit of luck.
So Jeff, right now, people are all of a sudden obsessed about private credit. You've been a debt investor for much of your career. Is private credit a big problem for the U.S. economy?
I actually don't think it's a big problem for the U.S. economy because it's not systemic in nature. The private credit market is very large. It's measured in the trillions of dollars. But do I think it poses a systemic risk? I don't. I think you also have to be careful with the phrase private credit. I think most people associate it with lending, direct lending. You read a lot about direct lending these days. But private credit is also buying a distressed, non-performing loan at 10 cents on the dollar. They're all under that umbrella. I think when most people use the phrase, they think about it as a lending product.
Is AI affecting your investment world?
Very much so. So in many ways. First, it affects what we do in this office, how we go about analyzing something, how our younger people build their models. When we go to investment committee, sometimes we'll take an investment committee memo that we've prepared and we'll run it through AI to see what we've learned. So it's impacting the day-to-day business of investing, for sure. It's also impacting the companies we invest in, whether as a credit investor or as an equity investor. It's kind of like a slow-moving train wreck in terms of its potential impact, which is accelerating. I think if you think about how quickly it's changing, and then you try to anticipate what's it going to be like a year from now, or 3 years from now, or 5 years from now, it's kind of unimaginable.
In the investing business that you're in, will you need fewer people because you're going to have AI make the investment decisions, or is that not realistic?
I think theoretically that's possible, but in the real world, AI is not a substitute for judgment or intuition or things like that. So I think it's possible. Could you have fewer people doing a specific task? Certainly that's the case. But is it going to supplant human judgment in terms of should we buy this company or should we lend money to this company? I don't believe that.
So let's talk about your company, Centerbridge. So your company today, what percentage of your money is being invested in, of your $46 billion or so, is invested in debt?
Our private credit business, which is pretty expansive, is around $22 billion of that.
And the rest of your money is invested in what?
Around 18 or 19 billion is in private equity, and the balance are in real estate strategies.
So today, if I said I have some money, I want to give you some money, but I don't really know where I should put it, real estate, private credit, private equity, what would you advise me?
David, for you, we're going to create a special fund to do all of the above.
So when people call you up and they say, I don't know what to do with my money, what do you tell them today? You put it in private credit, private
kidding
equity?
Aside, it depends on your return target as well as your risk tolerance. So obviously, an equity product, all things being equal, is going to have a higher return and higher risk than an equity product. So it depends what you're looking for.
Are you worried about the U.S. economy going into a recession? We haven't had a recession in quite a while. Are you worried about that possibly occurring?
I'm a worrier. I'm a contrarian. I'm by background a credit person, so I'm always focused on downside and risk. That said, do I see that happening anytime soon? I don't. We can speak to the people who run our businesses and get their take. And of course, there are always bumps in every company, but we think the U.S. economy is in reasonable shape.
What about the war? Do you think the war is going to affect the U.S. economy adversely or in some other way?
I think it depends on how long it goes. If you actually look historically at geopolitical events, wars and things like that, equity markets at least typically recover very quickly. It's like 39 days for the equity markets to recover after some big geopolitical blow-up or event. And clearly now, at least as of today, the equity markets are looking through the end of the war because they're either at or near all-time highs. But I think if the war continues and the price of oil remains high and you get into practical impacts, less so in this world, but let's say that Asia or Europe runs out of jet fuel. Well, that could have a real ripple effect here.
In the financial service world, one of the big issues going on now is 401ks and IRAs. Are they going to be allowed finally to invest a part of their money into private equity, private credit? What do you think about the risks of that? Do you think it's a good idea or not a good idea?
I think it's a good idea with one giant caveat. And that caveat is people have to understand what they're investing in. And if they don't, they shouldn't be investing in it. So I'm sure there is a subsection of people that have an IRA or a 401k that they understand what they're investing in, and I think it's perfectly appropriate. Now, obviously, they can't put all their eggs in one basket. They have to diversify, but why shouldn't they have the opportunity? But conversely, if you don't understand, you just shouldn't be doing it.
Well, very often people are now advised to put your money into index funds, stock index fund, bond index fund, just be the same as the market. What is your view on what the average person should do?
I would say, I think Warren Buffett said this many years ago, if he wasn't a professional investor, I think his advice was to take, 80 or 90% of your money and put it in the S&P with like no fees, and then you can take the other money around the edges. That made a lot of sense to me. If you're not a professional investor, or if you're not deeply and seriously interested in markets. But if you're just kind of winging it and I'm working and I worry about the investments, if you need a good financial advisor, but I think to have a chunk of your money in an index fund makes sense. But if you have an interest in something and there are plenty of good ideas, it's certainly appropriate. Depends upon your level of sophistication.
So if somebody says, I want to invest in private equity today, you're a good private equity investor, what kind of return can I expect to get, and what kind of returns do you tell investors they should reasonably expect to get?
What matters is how much you're going to put into your pocket. I think if you can generate, a close to a 20% net return, high teens net return, that's great. Okay, that's a hard thing to do consistently. What's happened in the private equity world as it's become more institutionalized and more capital has come in, and I think that will be the case, and perhaps that capital is coming from a new source, from the wealth channel. But when money comes in and there's a finite number of opportunities, what happens to returns?
Where do you get your deal ideas from? Do Wall Street people call you up and tell you this is a good idea, or you kind of do your own research? Where do you get your best ideas from?
It's both, but I think the way we've built the firm, and I think it's pretty instructive. So let's say industrials is one of the industry verticals that we focus on. Okay? Typical firm with multiple strategies, so private equity and private credit, they'll have two different teams. Our premise when we started the firm, and continues to this day, if you do industrials, you invest up and down the capital structure, from debt to equity. And so to your question about sourcing, having that flexibility, if you're an industrials investor and you're indifferent as to whether it's an equity or investment or credit investment, leads to better sourcing because you're sourcing from multiple channels.
Now, what about investing in Europe? Are you an investor in Europe as well?
We are.
And why do you think Europe has lagged behind the United States in GDP, technology, among other things?
I think that it's been that way for a really long time. It's population growth or lack thereof. It's regulation. Europe, as you well know, is a series of very different, and I'm not just talking legal systems, business culture is different. Occasionally currencies are different, far less so today. So I think you have to look at it discretely, economy by economy, as opposed to looking at Europe generally. It's no fun to lose money, but you have to be disciplined and you have to be ruthless, cold-blooded in making those decisions.
So to do your job, how do you keep informed? Do you have outside experts that advise you on things? Where's your news information coming from?
I'm a voracious reader. My wife is always teasing me, am I reading another article? And in family chats, I'm always sending out articles and I get a collective eye roll from my family. But I love to read, so I probably read 5 newspapers a day. And I'm on my Bloomberg all the time, and I like talking to people and learning. To be a good investor, I think you have to be a good observer and a good listener.
Now, investors sometimes make mistakes. So if you make a mistake, how long before you realize it's a mistake and you do something different?
It depends. If it's a liquid instrument, I think taking a loss it's a hallmark of a good investor. It's hard. It's no fun to lose money, but you have to be disciplined and you have to be ruthless, cold-blooded in making those decisions. One of the problems that investors have, I find, whether you're a private equity investor, private credit investor, or you're just buying stocks, is let's say you bought a stock at 100 and it goes to 60. Or you bought a company at $1 billion and now it's worth 700 million, or a piece of debt you lent at 100 and now it's worth 80. The natural reaction is, I just want to get my money back. And that is just the wrong way to look at it. Because that's gone. The only thing that matters as an investor is what are you doing today and tomorrow, not what you did last year.
Let's talk for a moment about your own background, how you came to start this firm. So where were you born?
I was born in Springfield, Massachusetts, where the Basketball Hall of Fame is. My father actually was an athlete, and my father started his career as a phys ed teacher in local public schools outside of Boston, and eventually became a coach and a physical education professor at a state university in Massachusetts.
And your mother?
My mom was a homemaker.
And you have siblings?
I have a younger brother who actually lives here in New York City.
Where did you go to high school?
Needham High School.
And I assume you did reasonably well there because you got into Johns Hopkins?
Did. Mm-hmm.
So what did you study there?
Political science. Mm-hmm.
And so what did you intend to do with that degree?
I thought I would go to law school, which is what I ultimately did. But in truth, I really didn't know what that entailed. Law school sounded good. And I was always interested in government and public policy, and that sounded kind of cool. I knew nothing about business because my father had nothing to do with business. So I went to Hopkins. I did well. It's been a big part of my life ever since. I went to law school here in New York City at NYU. And I came out as a lawyer, and I worked at a big law firm, and I said, this wasn't for me.
So after you left the practice of law, what did you do?
So I lasted about 2 years at the law firm. And I found a new job as a lawyer in the legal department of this small investment bank called LF Rothschild.
How did you transition from doing legal work to being an investor?
It's a good story. So part of my job was to advise the team that was managing the firm's proprietary capital, where they invested in merger arbitrage, they invested in distressed securities and things like that. So it was all event-driven investing. And the two individuals who ran that team, one was a fellow named John Angelo, another was a person named Michael Gordon. And so I befriended them, and I thought what they did was really interesting. And then what happened? The stock market crashed in 1987, and LF Rothschild went out of business. I'm newly married. I have student loans up to my neck. I don't want to be a lawyer, and my firm just went bankrupt. So I went to John and Michael, and I literally said, give me a chance. I want to be an analyst. One of them joked with me, well, you're a lawyer. You don't know how to add. And I said, I'm actually okay at math. And I actually said, I'll work for free. Now, I was hoping they wouldn't take me up on it. But they gave me a chance. And when Angelo Gordon started, which is obviously a well-known name in the alternatives world, I was one of the first employees.
So you worked at Angelo Gordon for a long time, I guess.
For a long time. Mm-hmm.
And ultimately...
from the late 80s to 2005.
When did you say to Angelo and Gordon, why don't you put my name on it or I'll go somewhere else?
It's funny, I never said that. I didn't care about my name being on the door. We never argued over money or anything like that. I mean, they made me wealthy. I mean, I returned the favor many times over, but that was all good. What I did want, and it's really informed how I think about my role here at Centerbridge, I wanted a chance, the phrase I used, to drive the bus. I wanted to run the company someday. And I understood their position as a founder, that they loved their company. They didn't want that to happen. So when I left, I told them, my heart was racing, and I told them, and I really love these guys because I tell people they raised me professionally. And I said, I want to do my own thing. I'm going to do it with a good friend of mine who's also leaving his firm, and John Angelo. So he's kind of a larger-than-life Wall Street character. He stood up and he hugged me. He always called me Jeffrey. He said, Jeffrey, we've thought of you as our son. And as I went home and I shared that story with my wife, that was exactly the problem, is that I'd worked with him and Michael for like decades, that I was still 26, but I was 45.
So you left at the age of 45?
Yeah.
And where'd you get the name Centerbridge from?
So my partner, a good friend of mine named Mark Galogli, who you also know.
He was at Blackstone.
He was at Blackstone. And Mark's background was private equity, and mine was credit, now called private credit. So the idea behind the firm is that we wanted to take best of class talent from both worlds, the private equity world and the private credit world. Centerbridge came from the fact that we were going to take these strategies and bridge them to the center.
And today, you have any outside investors, or it's all owned by the employees?
No, all owned by the employees.
Okay, and you're not taking it public anytime soon?
Nope.
And you intend to stay for the foreseeable future?
No, I left Angelo Gordon because I was never going to get a chance to run the business, which is certainly the prerogative of the founders. But I said I didn't want to do that, because what will happen to your best talent if you don't offer the opportunity for them to grow and lead? They're going to do what I did. So I've been really transparent. I have a successor named. I've told everyone. I've given people my timeline, and when
how
that
many
happens,
more years? Tell me, how many more years is it?
When I turn 70, I'm 67 now. I could have a limited role here, but like a non-executive role, like a chair or something like that. And I'm a deep believer in philanthropy. I think I'm really lucky to live in this country, and I've done really well. So, sharing it gives me a lot of pleasure. You really have to love what you do. I think a lot of people work in financial services because they view it as a path to wealth. This is a great country. You will find the money, or the money will find you.
When you started the company in 2005, at that time, I wouldn't say it was easy, but it was easier to raise private equity dollars, because there were more people that seemed to think that private equity returns were going to be pretty spectacular. Today, it's widely thought to be harder to raise money. Do you have to go out and raise money yourself?
Money never comes in easily, even whether today or in 2005 or when I started in the business a long time ago.
So you still make fundraising calls?
I still do, and I enjoy that. I enjoy being with people. I like talking to our clients and see, can we help them? I mean, for example, if a client wants to invest in private credit, I think we have a very compelling offering. If someone wanted to invest in Asian real estate, I'd say we can't help them. We're not all things to all people.
There's somebody that wants to start a private equity firm today. Do you think it's kind of late to start a new private equity firm of any size and grow it because there's so many firms out there?
You really have to love what you do. I think a lot of people work in financial services because they view it as a path to wealth. I think the people who do this best, they love investing because they find it intrinsically interesting, and it just happens to be a profession that if you're skilled at, it can be really lucrative. So I think if you're passionate about investing and you can prove that and you're actually good at it, I mean, I said this earlier, this is a great country. You will find the money or the money will find you.
So many firms that succeed and have second generations and even third generations have a common culture that permeates through the generations. What kind of culture have you tried to inculcate here?
That's a great question. So I think about that a lot. I talk to our clients about that a lot, particularly for young people. I think the capital here is a lot of money. It's like an abstraction. It's just kind of there. And I think people, particularly younger people, tend to forget it's not our money. It belongs to someone. And our clients are entrusting us with their money. It doesn't mean we're infallible. We make mistakes like everyone else. But you have to think about the capital as being more important than your own money. I think that's a really important thing. I am very even-keeled, as you pointed out. The only time I will get agitated is when people second guess. I said this earlier, as an investor, it's so easy to second guess yourself, but I find it's not a good use of time. You obviously have to learn from your mistakes, but what matters as an investor is not what you did when you made the investment. What matters is today.
One of your philanthropies has been City University of New York. You didn't go to the City University of New York, so why are you so interested in the City University of New York?
It's an undiscovered jewel right here in New York City. So as an employer, we're always looking for, really talented young people. And I find whether you're a private equity firm or a private capital firm or a big bank, we all go to the same stomping grounds to look. And I think there's this enormous pool of untapped talent right in our backyard.
So for somebody that's young, like the young people coming out of City University of New York, what would you recommend they do with their money?
I would, if I were them, I would invest in equities, in public equities, and probably an index fund. And I would start when you're young, if your employer offers a 401k or an IRA, and start to compound. And as you know, compounding is the key. And if you compound over a long period, can you imagine if you had started investing when you got out of law school and you were putting several $1,000s a year in a 401k or an IRA? I mean, it would be worth a lot of money today. So I think that'd be really good advice.
So if you could live your career over again, what would you have done differently?
I'm incredibly lucky. I'm not superstitious, but I'm a lucky person. And I've been in the right place in the right time. And that's why this is a great country. I mean, just like you, I know your background, David, as a Baltimorean. Look what this country is able to afford someone if you're smart and you're hardworking and ambitious and have a little bit of luck.